Hello and welcome to Inside the Research with iCM. This is our pre-election special. I'm Pete Seiler, Senior Investment Specialist here at iCM, and I'm joined by our Director of Investments, Ryan Lehman. Ryan, thanks for taking some time here.
Happy to be here, Pete.
So, Ryan, ultimately, regardless of where you're looking, we're bombarded with election news and political ads. And with the big day less than a week away, what should investors be thinking about as it relates to their portfolios?
Yeah, honestly, I think the answer here is really simple. So, completely taking politics out of this, regardless of who you're going to be voting for or who you think is going to win the election, you really just need to take fear and emotion out of the equation. And this sounds really easy to do, but investors tend to be driven by risk aversion and this need to feel in control of their portfolios. And it can become very uncomfortable when our investment portfolios are exposed to external factors that we can't control, especially when we're desiring one outcome and we might actually end up with the opposite. So, that said, I think the best strategy right now is really just to stick to your financial plan, which should be designed with long-term goals in mind rather than focusing on the short term.
All right, so you said the magic word, short term. And as far as short term outcomes go, thinking on that basis, how have markets historically performed around elections?
Yeah, great question. And I think a lot of investors, they kind of have this preconceived notion that markets are going to be highly volatile around elections and that they might just be better off getting out of the market altogether until things kind of sort themselves out. And in reality, this isn't true. So I do have a chart I'd like to share here. Yeah, so just looking at this chart, if we go back to the inception of the S&P 500, which is back in 1926, we've got 24 total elections that we can look at. And of those 24 election years, 20 were positive, with two of them coinciding with the bursting of the technology bubble back in 2000, and then the peak of the great financial crisis in 2008. In addition, if we were to just look at simple average returns across election years and non-election years over that entire period, what you're going to find is that they're nearly identical. So you had a return just shy of 12% during election years and then 12.4% during non-election years. And interestingly enough, those election years, which you would think would be more volatile in terms of the performance dispersion, standard deviation was about 16 and a half. And then if you look at the non-election years, your standard deviation was about 21.
All right, so at a high level, you were kind of just addressing election years in isolation. What about investors who are, a little worried more about which party may win and the impact that their policies might have on the stock market? This election, probably more than most, seems to be, as polarizing as ever. And I could see this really weighing heavily on investors' minds.
Yeah, I couldn't agree more with you. So if we again go back to 1926, so we've had 24 election years, which I already mentioned, and we've seen a pretty interesting or even split between administrations. So I have another chart I'll go ahead and share. So if we look all the way back, you've got 11 Republican administrations and then 13 Democratic. And if we look at performance during just election years, I don't think this really does us much good because you don't really get to necessarily see the impact of a president's agenda and their policies. So instead, what we can do is we can actually look at average returns over a president's full term to get an indication of really whether the market performs better under the two different parties. And I think the data here is interesting. Now, if you look at it at just a really high level, it clearly looks like Democrats have the clear advantage with a return of about 14% versus around 6.5% for Republicans. However, these numbers are going to be really heavily skewed by two periods. So you're going to have the Great Depression, which occurred during the Hoover administration way back, and then the Great Financial Crisis that occurred under George W. Bush. And if you strip out those periods and then the corresponding snapbacks, what you're going to see is that the returns are essentially the same. They're within 1% or so of each other across the two different parties.
All right, so how about volatility? I mean, you'd think that with so much uncertainty leading up to an election, that volatility would probably really increase for stocks.
Yeah. Again, I agree in theory that makes complete sense. But if we just look at volatility leading up to and then post elections, honestly, you don't really see it. And I've got one more chart to share with everybody today. So here what we're doing is we're looking at the VIX to measure equity market volatility, and the VIX goes back to about 1990. So we can start our analysis at the 92 election, and in total that's going to give us 8 observable election events. And vol looks pretty stable leading up to and after the elections. Honestly, there's a couple of spikes, but you need to take those with a little bit of a grain of salt because they coincided with the GFC and then the COVID-19 pandemic, where volatility was
Okay.
kind of elevated in the first place. Now, just to dive a little bit deeper, our friends over at Research Affiliates actually put out a really interesting research piece just a few months ago. If anybody's interested, it's titled "Elections and the Stock Market: Polarization, Trump's Politics." And what they did in the paper is they examined equity market performance and volatility around elections, and they had some really interesting findings. So, most notably, what they did, which is kind of different, is they segmented elections all the way back to 1928 into either landslides or close elections. And what they found is that volatility really stable during landslide elections, which pretty intuitive here because the market essentially knows what your outcome is going to be, who's going to be
Sure.
elected,
Yep.
right? But during those toss-ups or the close elections, it gets really interesting. So volatility kind of subdued in the run-up to the election, and then it actually spikes shortly thereafter, but almost in a good way. And their hypothesis is essentially that you have both sides taking risk off the table before the election, but the side that wins feels this sense of relief when their candidate wins and kind of pushes their chips back onto the table. They move their money back into the
Sure.
market. So essentially what you see is kind of that big upward move of that the winning party's assets coming back in. So what you could see is if history repeats itself, you could see a big upward move following the results of the election this time around, regardless of who wins. Something similar to, if we think back just a couple years, the 2016 election when markets soared following the Trump Clinton election.
Okay, so let's take a little bit more of a historical view of this. Are there any asset classes that have historically benefited during elections or might specifically benefit this time around?
Yeah, great question. This is another one that Research Affiliates tried to tackle in that paper that I mentioned a few minutes ago. And again, they found some really interesting results. So I'm going to specifically focus on style or growth versus value. And again, they measured this going back to 1928. And what they found is that during those landslide elections, style performance tended to be equivalent, didn't really matter. They weren't statistically different from one another. But when you get into those close elections, much different story. They actually found that value actually outperformed by a pretty wide margin, and in cumulative by roughly 6% over the entire election period. And they looked at 30 days prior to 30 days after, so 6% roughly outperformance by value over growth. And I think the question here is, why might this occur? And I think it kind of comes down to the risk premium that's offered by value stocks compared to growth, which is why they historically trade at cheaper valuations. And if we think back to what we just talked about a minute ago, in close elections, it potentially creates the sense of relief for investors who are on the side of the winning party, which could drive assets to those higher risk premium asset classes like value. And then, not surprisingly, you also see similar results if you were to look at small caps versus large caps, where higher risk small caps have also tended to outperform in the month following those close election results.
Really great stuff here, Ryan. So, to bring this to a close, if you had one piece of advice for investors who are thinking about how to position their portfolios around next week's big news, what would it be?
Yeah, I think it's really just a summary of everything we talked about today. So, first off, on the volatility and asset class front, the trends I talked about, they're based on historical data. They don't take into account the prevailing market environments. So, I would keep those things in mind, but they wouldn't lead me to reposition my portfolio over the short term. I think the big takeaway is to continue to focus on the long term because regardless of whether it's an election year or not, whether the Republicans or the Democrats win on November 5th, long-term equity market performance tends to be relatively similar across all of these different political environments. So I would say a couple really simple things: stick to your plan, stick to your appropriate risk tolerance, and then continue to focus on assets with the most attractive valuations because that's really what tends to drive returns over the long term.
Great, Ryan. Thanks again for dropping in, and thank you for taking time to watch this Inside the Research with ICM pre-election special.